and welcome to the Tax Track, the podcast series from ICAEW, where we explore the latest developments in the world of tax and what they mean for our members and tax professionals alike. In this episode, we're talking about the challenges posed by the government's aim to payroll all benefits by 2026.
There's so many changes going through that it is quite hard for employers to keep up with it all.
And we look at a recent tribunal case in which a nursery tripped up over entrepreneurs' relief.
If you're a taxpayer and you've taken advice, then this case illustrates the need to check that advice is still current.
I'm Lindsey Wicks, Senior Technical Manager for Tax Policy at ICAEW. I'm joined this month by Stephen Relf, Technical Manager Tax, and Peter Bickley, Technical Manager Tax. Welcome to you both.
Hi, Lindsey.
Hi, Lindsey.
Payrolling of benefits is in the news at the moment. First of all, agents can now register to payroll benefits in kind on behalf of their clients for the 2025-26 tax year onwards. And mandatory payrolling is coming in from 6th of April 2026. Peter, what's the reason behind the change?
Well, I think there's really part of the revenue's push and the government's push for digitalisation, and they want to get rid of the form P11D that they've already been describing as a legacy form, and it would enable the revenue to not have to process 4 million end-of-year forms, which would obviously ease their workload. It's sort of being sold as simplification, but I don't think it's simpler for employers nor for advisors, because there's going to be much more having to get information to payroll every payday. So instead of just doing a P11D once a year, they're going to have to do it every payday.
And what do we know so far?
First of all, it's meant to be all benefits in kind. So it's going to include accommodation and beneficial loans, which hitherto have not been included within payrolling, even if you're doing it voluntarily. P11Ds that people will be submitting for 25-26 are supposed to be the final ones that will be needed, but we believe that there will still be a place for P11Ds for sort of leavers and people who are not paid any money. So we're not quite so convinced that it is the end of the P11D yet. One of the other things we know so far is that there's going to be real-time reporting from April 2026. So that means all benefits in kind will have to be reported in payroll in real time. Class 1A NICs will be paid in year instead of at the end of the year using the P11DB. That raises questions of sort of will it have its own identification reference number when you pay it, like Pay As You Earn does at the moment, and indeed like Class 1A does at the moment.
And Peter, how will it look post-April 2026 for employees and employers?
It's going to look different because everything will be going through the pay slip. For employers, it's going to be a lot of work, as I say, getting the information to payroll in time. So some interesting times coming up.
Yeah, as you mentioned, it doesn't sound like it's going to be simpler for employers or their advisors. So what are the main challenges?
Well, I think the main challenges is that it's getting accurate data and efficient processes in order to get the information into payroll in real time, because you're meant to be reporting, as you do if you payroll benefits in kind at the moment, you're payrolling the benefit in kind for that month or week in that period. So payroll might not know that this car has been substituted for another car or whatever. So I think probably the processes of getting the information to payroll is probably going to be the most challenging thing. Also, where you have agents or payroll bureau, it's going to be even more challenging making sure you get the information to them on time to be run through the payroll. You've got expat employees. Are they going to be included in this? And their benefits are sometimes quite interesting, and they take, again, the period that it takes to get the information in. Some benefits are more difficult than others to payroll, like accommodation and beneficial loans, because you don't really know what the figure is until after the pay period or even after the year end, because for loans, of course, you can do it on an annual basis. And getting the information about cars is all interesting at the moment. So,
yeah,
especially
currently you have to do that quarterly, don't you? Is it the P46 car?
That's right, yeah. So quarterly is probably about enough, but I think even then it's quite hard because, you've got to get the information in, process it, and if you've got fleet providers, third parties, maybe their systems are not compatible with yours. So under payrolling, everybody's computer systems will need to mesh together somewhat more than they do at the moment. And of course, you've got starters, So perhaps there's going to be a month where the starter doesn't get his benefit in kind put through the payroll in the first month, and leavers and people who don't get paid any cash benefits. Yes, there's a lot of queries that we have raised with HMRC, actually.
It does seem as well, though, that every year we seem to ask more and more of payroll. So thinking about longer-term auto-enrolment, RTI, we've had the recent changes to national insurance contribution rates.
Yeah.
Are we at a point where we just can't keep putting more and more on a burden on payroll, do you think?
The thing is that there's so many changes going through that it is quite hard for employers to keep up with it all. If there's notice, then the software can be developed, so that works. And if the software perhaps gives prompts to employers, that will help as well. But it's going to be new processes, so it is hard, actually.
So do you think there's anything that employers should do now to try and get ahead of the game when it comes to payrolling benefits?
I would suggest perhaps that employers should register next year to put through a couple of easy benefits if you're not already doing it. Perhaps if you have, gym membership or medical benefit, put that through payroll and just see how it works and get the process.
I hadn't appreciated you can pick and choose how to what extent you do it. So it's not an all for nothing thing at this point.
Yeah, that's correct. At the moment, you choose your benefits and you can choose your employees as well, actually. Right. So you can perhaps put through a couple of easy benefits and get the hang of it before the big bang in 2026. We have suggested to the Revenue that perhaps if they want to mandate this, that they do it in a slightly more softy basis, perhaps mandate the easy benefits if they want to do that. And then once that's all bedded in and everything works, then perhaps move on to mandate the more difficult benefits and perhaps even change the rules from accommodation and beneficial loans that is actually possible to payroll them in the year. And perhaps on the accommodation one, get rid of the rateable value.
It's a really good point, though, isn't it? Because I think we all know the challenges of completing forms P11D, but largely it's to do with working out the amount that's taxable as a benefit in kind. It's not necessarily putting the numbers into the form. So, as you say, this is really, really a true simplification if they actually change some of the rules for calculating the benefits.
Yeah, or maybe, a bit of an off-the-wall thing, perhaps do it on a sort of previous month's basis, so at least you have a bit of an opportunity to find out what the benefit was in that month before you have to put it through payroll, which perhaps sounds a bit old-fashioned, sounds a bit like the PYB for traders, doesn't it?
We do have a tendency to go back in time in tax, don't we, and rediscover things that worked in the past.
Exactly.
And at the moment, it's a once-a-year process, isn't it?
Yeah. You do your P11, you get all the information in, stick it on the P11D by the 6th of July and send it in and pay the Class 1A. But so that does give you a bit more time to get the information in and make sure it's right and perhaps even query if it's not right before you have to return it to the Revenue. So,
but it's also a once-a-year opportunity for registering to payroll at the moment, isn't it?
Yes, it is. Yes, that's right. So if you want to dip the toe in the water, then you have to register to payroll before the 6th of April for the year you want to payroll in. So it's a sort of whole year thing, but you must register before sort of 2,200 hours on the 5th of April before it. You can't sort of dip in now with a few benefits for the rest of the year if you haven't registered before the 6th of April of the current year.
And it's also not possible for new employers either at the moment, is it?
No, that's right. So if you start up, say, now as a new employer, you wouldn't be able to payroll until the next 6th of April, and you'd have to remember to register before the end of the year.
So from the employer's perspective, it does sound like it's worth doing, even if just to test the waters. But what would you say are the main problems with payrolling benefits at the moment? Well,
the main problems, I think, are actually getting the information to payroll quickly enough. Although if you payroll, there's no need to submit P11Ds, you still need to submit the P11DBs to account for the Class 1A national insurance contributions. You've got to provide the information to employees on what their benefits are by the 31st of May instead of the 6th of July so that you can do it as part of the P60 provision, although you can just tell them to look at their final pay slip for the tax year. That's good enough. It's also applying the making good rules. Generally, making good can be, that's when employees pay the employer for sort of the benefit in kind to reduce the benefit. At the moment, the deadline is 6th of July if the benefit goes on P11D, whereas if it's payrolled, then the making good is sort of some benefits 31st of May. There's also the 50% rule, which means that employers cannot sort of deduct more than 50% of gross in tax from the employee's pay. And of course, you've got other issues like leavers, for whom it would be quite difficult to perhaps put in the final benefit in kind after they've left because there's no cash emoluments from which to deduct the tax. And employees who don't actually get paid any cash emoluments, so they have only benefits in kind, so there isn't any cash from which to deduct the tax. So that's just a few of the sort of complexities which, if you payroll in kind, you have to think about.
What should employers or agents do now to prepare?
Probably, as we said earlier, I think probably consider registering by the 5th of April 25 for 25/6. As I say, do a few simple benefits. The main thing, of course, is to communicate what you're going to do to your staff, because it's going to have impact on the employees. So employers and agents, well, they obviously need to review their processes, think where the risky areas are, and they have to keep up to date with what's going on. So keep an eye on employer bulletin and the agent's update, which we normally sort of flag up in our tax wires and news items.
Yeah, it does feel like everything's gone quiet since that initial announcement back in January that there is going to be mandatory payrolling for 2026. As you've mentioned, we've got the articles. We will keep people up to date. We've already got a tax line article that you wrote last year, Peter, on payrolling of benefits as it currently stands. And we'll be running a webinar on this topic on the 16th of October, and hopefully we'll have some more information to share by then. A link will be included in the show notes for this episode if you'd like to book. So let's move on to another article now, this time by Stephen. You wrote about a tax case involving what was then called Entrepreneurs Relief and now known as Business Asset Disposal Relief for Taxline. What was that case about?
Yeah, thanks, Lindsey. So this is a decision from the First Tier Tribunal, FTT, and it's the case of Delaney. So Mrs. Delaney, she ran a nursery business. Initially, she did that in her own name as a sole trader, but later on, she decided to incorporate her business, which meant transferring it to a limited company of which she is the main or sole shareholder. Now, on doing that, she triggered a capital gain on the transfer of the goodwill, and so she had a CGT bill to pay. Now, it's at this point where there begins to be a disagreement between Mrs. Delaney and HMRC. Mrs. Delaney believed that the correct tax rate was 10% because of the availability of Entrepreneurs Relief, now known as Business Asset Disposal Relief. HMRC rejected that, Entrepreneurs Relief was not due, and the tax rate, which at that point, the higher rate was 28%. So quite a significant difference there in the two views on how much tax is payable. Because the goodwill was valued at somewhere over £1 million, the actual difference in real terms was close to £200,000 of tax, so quite a significant number. And at the heart of the problem were changes that were made to Entrepreneurs Relief effective from the 3rd of December 2014. Now, on that day, the then Chancellor George Osborne had delivered his autumn statement, and he had announced that effective from that date, Entrepreneurs Relief was no longer available on the transfer of goodwill in an incorporation. So the key issue really was, did that transfer of goodwill take place before the 3rd of December 2014 or after the 3rd of December 2014? Now, had there been a business transfer agreement or formal documentation of that kind of type, that would have been really easy to determine. The date would have been clear. But unfortunately, in this case, there was very little in the way of actual documentation. And so it fell to the FTT to try and work out what the date of disposal was based on the evidence that was available to it.
And so what was the story?
So Mrs. Delaney had started to trade back in 1996. And if we roll forward to 2011, the business at that point was quite successful and she was trading from two different sites. And it appears that that was the point where it was first suggested to her that incorporating the business could be of benefit to her. Now, early the next year, 2012, she'd started to enter into negotiations with the landlords to renew the leases on the two sites for our nursery. And at that point, she raised the idea with them of the lease being in the name of a new company. Now, those negotiations continued throughout 2012, but unfortunately, ultimately, they were unsuccessful, and that left Mrs. Delaney looking for new premises. And by the end of that year, so roughly December 2013, she'd identified new premises big enough to handle both sites, and she was going to press ahead with that. So at that point, she registered the new company with Companies House, and from then on, all negotiations with the landlord were done in that company's name.
So it sounds like everything was on track to happen before that date in December 2014.
Yeah, certainly at that point, things were looking good. But as is often the case, there were some problems with the landlord. And although they did actually go ahead, it wasn't until September 2013 that the company agreed terms with the landlord. There was then also still quite a lot to do. So that property had been in residential use. So the company had to apply for planning permission for change of use. There was building work to do so that it was fit to run a nursery out of. And also once all that was done, the company then had to apply to Ofsted to be registered. So that was all done by the 1st of September 2015. And at that point, the company opened the nursery business in the new premises and operated the nursery from that date. Now, as we discussed earlier, there is no formal documentation. So here we have a contract that was undertaken by conduct. Mrs. Delaney believed that that contract was effective from the date the company was registered with Companies House, and certainly before December 2014. Now, HMRC believed that the contract was effective on or around the 1st of September 2015, when the company was actively running the business, and certainly after December 14. Now, the FTT agreed with HMRC, finding that at December 14, the company was not in a position to buy or to run that nursery business.
So what are the big takeaways from this case?
So I think there are two kind of wider points of interest here for me. The first is around the lack of documentation. So the burden of proving the case fell on Mrs. Delaney, and she was unable to do that because she could not point to a formal document that said when the transfer took place. It's mentioned in the decision as to why that's the case. So solicitors had been lined up to prepare documentation. That hadn't happened, and it is suggested that was due to cost concerns. Now, the FTT did describe that decision as naive, and also with hindsight, clearly it's potentially quite expensive because it may well have cost Mrs. Delaney, in this case, close to £200,000. And I think the second point is if you're a taxpayer and you've taken advice, then this case illustrates the need to check that advice is still current before you act. Because as we've seen here, there can be events in your business or in your personal life which impact on that advice. And also you can get significant tax changes which take effect very quickly.
On that case, it was on the day it was announced.
That's correct.
And do we have any sympathy for the taxpayer given that this change was made without any notice being given? I mean, personally, if it's your company and you're transferring goodwill from yourself as a trader to the company, you can kind of understand a little bit the cost mentality, but equally you can understand as professional accountants that piece of paper could have played a key part in this.
I think as well it's remembering that this is an incorporation, so it's not a sale to a third party, and therefore no new funds came into this business out of which to pay the tax. So ultimately Mrs. Delaney here has crystallised a significant tax liability when she didn't necessarily need to do that. And I think it is significant, the tax liability, partly because of events outside of her control. So, for example, had the first landlords been amenable, then it's possible that the company would have been trading from the original premises well in advance of December 14, and this would never have been an issue. And also, as you mentioned, those tax changes. So we had the change to entrepreneurs relief effective on in December 14, announced on the day. But also, if we roll forward a little bit, from April 16, that tax rate of 28% was cut to 20%. So effectively, in a period of less than 18 months, we had a tax rate that went from 10% to 28% to 20%. And it's really just Mrs. Delaney's misfortune that transfer was found to have occurred too late for 10% and too early for 20%.
Stephen, so when does the transfer actually occur? Is it when the company is incorporated or when the trade starts? Or
ideally for a business of this size, and it is worth remembering that this was actually quite a successful business at this point, that you would have a formal process in place for transferring the business and all of its assets. So there would be a document that sets a date, and in advance of that date, you would, for example, write to parents and change contracts. You would let everyone know. So it is quite a significant undertaking. But in this case, it's almost been done unofficially over a period of time. So as you say, in that situation, it's a little bit of confusion as to when the decision to transfer the goodwill actually did happen. And there are a number of key events going back to when the company was first registered, from there all the way through to when the doors open. So it did make it extremely difficult in this position. And yeah, had Mrs. Delaney prepared the agreements and gone with a formal process, this would have been a lot clearer.
Well, I suppose when it's your own company, you do tend to treat it as your own, and the formalities do sometimes go out of the window.
I think that raises a really good point, though, because certainly in the past, a lot of people incorporated their businesses without necessarily understanding what that meant. It was still their business.
Yeah.
And that applies for the incorporation process itself, but also possibly more importantly, how they ran the company afterwards. So I think an awful lot of people get confused about what used to be drawings but then suddenly become dividends.
Yeah.
So it can cause an awful lot of problems, and it is important that people fully understand the consequences of their actions.
Thank you. And I think it's also a really good case for demonstrating why advisors get very nervous about entrepreneurs relief, as it was, or business asset disposal relief now, around any fiscal event and whether we'll get any sudden changes announced, because history has shown that we have, and this case demonstrates the consequences.
Yeah, it has been and probably will be a real political football. And as you say, we do always keep one eye on it when it comes to budgets and autumn statements.
Yeah. That's it for this episode. Many thanks to Stephen and Peter for your contributions.
Thanks, Lindsey.
Thank you, Lindsey.
And thanks for listening. If you've missed anything, we've included some links for further reading in the show notes. And if you found it useful, then don't forget to subscribe so you never miss an episode. You can rate and share the podcast too. We'll be back next month with the next tax track. In the meantime, why not check out the sister podcasts from ICAEW? Insights provides business, finance and accountancy analysis, while each episode of In Focus offers a deep dive into a selected topic. There's also the recently launched Students podcast aimed at young professionals. If you're not already a member of ICAEW's tax faculty, remember that ICAEW members can join the faculty for no additional cost. Faculty members receive our monthly tax line bulletin. In addition, anyone can subscribe to receive our weekly tax wire bulletin containing the latest tax news from ICAEW. Thanks for listening.